We learned from the prior slides that accounting treatments have impact on the numbers or the financial statements. If there are any changes in accounting, so how to account for this change in the financial statements. So accounting changes fell into the three categories. One is a change in accounting principles or in accounting standards. Next one is change in estimate. Last one is change in reporting entities. Also, I will talk about the accounting treatment for the correction of prior errors in the financial statements. First, change in accounting principles. The change in accounting principles can be voluntary or mandatory. Mandatory change means the regulators or accounting standard setters update the accounting standards. So all the reporting entities must follow the new accounting standards by a certain day. So if the changes are mandatory, the companies have three approaches to implement the new accounting standards. One is retrospective approach. Basically, this approach, the company will use the new accounting standards in current year and restate financial statements in the prior year to make the financial statements are comparable and consistent. Next one is modified retrospective approach. This one does not require the company to restate their financial statements, but the company should adjust to the financial statement to show the accumulate impact from the change in accounting principles. Next one is prospective approach. The company just following the new accounting standards from now on. So there's nothing changed in the prior financial statements or adjustments. While voluntary change is a change made by the company, the reporting entities. So the company should account for the changes through the retrospective approach by restate prior year financial statements. The example of the change in accounting principle is the change in the inventory costing methods. For example, the company chose FIFO as a new inventory costing method instead of prior LIFO or weighted average. So this is a change in accounting principles. Change in accounting estimates, and this change only have impact on the financial statement prospectively. So in other words, the change in estimates only have impact on current year and future year financial statements. The examples include the estimates of future bad debt expense on existing accounts receivables, and expect of the useful life, residual value of depreciable assets, or the estimate future warranty expenses. So the change in depreciation, amortization, and depletion methods, so these are expenses, are the methods to account for the expense from depreciable assets, amortizable intangible assets, and depletion for the natural resources. These are all change in estimates, so the company only account for them prospectively, and the changes only have impact on current year financial statements when the changes become effective and the future financial statements. Since some changes in estimate have significant or material impact on the financial statements, which will have impact on the investors and the financial investors and the creditors' investment decision, so the company should justify the changes. Correction of accounting errors. The errors may be caused by a transaction being recorded incorrectly or not recorded at all. If the error was found during the year when it was recorded, simply the company just reverse the erroneous journal entry and prepare the correct journal entry. If the error was discovered in the subsequent years, the company should make adjustment to the prior period, only if the error is material. So if the error is material, accounting standards require the company to record a journal entry that adjusts any balance accounts to their appropriate level. So we should make adjustment to the balance sheet or the accounting equation, while the impact on the income statement from the error will be adjusted to the beginning balance of retained earnings of the year when the errors were discovered. In addition, the company should disclose this adjustment in the notes.